Singapore, Chinese PDH plant operator Oriental Energy's first-term contract with Qatar Petroleum for 600,000 MT of LPG supply over 2019 underscores the urgency faced by China to lock in stable and diversified supply while the trade war with the U.S. lingers, trade sources say. Receive daily email alerts, subscriber notes. Register now. It could also herald more such contracts with other Chinese importers who are already keen buyers of Middle East LPG via spot or term deals, they said. Directionally, this will be the right move, logically, a Chinese trader said. An East Asia-based trader said Chinese importers have no choice but to secure Middle East origin LPG. Other market sources said more long-term deals would be sought and signed with QP and Middle East producers such as Saudi Aramco, Kuwait Petroleum Corp., and the UAE's ADNOC. The contract with QP also comes as Chinese importers, key buyers of LPG from Iran due to access to their own vessels, brace for renewed sanctions due to be imposed by the U.S. next month. The QP Oriental contract was sealed at parity to the Saudi contract price, FOB basis, a market source said. The cargo ratio could be negotiated with the sellers, while other market sources predicted it would be evenly split between propane or butane, or 60-40, a source familiar with the matter said. A Middle Eastern source said Oriental Energy has already been lifting Qatari spot cargoes from traders holding term cargoes, and this is the first time the Chinese importer has contracted directly with QP. This underpins QP's aim of further enhancing its energy ties with China, as it places greater importance on meeting the needs of the world's largest growing LPG market, QP's chief said this week. The source said several other Chinese firms have sought term supply from QP, for which they will undergo a strict registration process lasting between 2 weeks and several months, to assess their financial security and counterparty risks. Chinese importers have been reducing U.S. origin LPG since March, ahead of higher tariffs, and lifted more from the Middle East and Africa. Chinese buyers have also sought to swap U.S. term cargoes with traders who have Middle East lots, paying a premium in the process, as well as resell U.S. cargoes in the spot market, traders said. China sees benefits in term Mideast LPG. The higher tariff imposed by China on U.S. imports is the latest issue to beset LPG trade from the U.S. to China. Oriental Energy in April was ordered by a Texas state district court to pay $523.8 million in damages to Germany's Mabanaft following a propane contract dispute, in which the Chinese firm was found to have breached the deal by failing to provide a letter of credit ahead of its first scheduled shipment. Oriental Energy in its defense said foreign exchange policy and banking restrictions in China made it impossible to provide the letters of credit. Under the contract signed in October 2013, Oriental Energy was to buy from Mabanaft 2 cargoes per month of U.S. propane, totaling at least 1.045 million barrels between January 2017 and December 2022, loading from the Houston Ship Channel. Oriental Energy this week was also heard to have been awarded a 45,000 MT spot export tender by Qatar Petroleum for the sale of petroleum products, RQPSPP, for November 12 to 19 loading. Oriental also won QPSPP's tenders for the same volume of propane for September 1 to 7 and a cargo comprising 33,750 MT of propane and 11,250 MT butane, or 45,000 MT of propane, for June 24 to 30 loading. QPSPP on Thursday offered via term tender 540,000 MT of evenly split LPG for 2019 supply, or through 2020. The East Asian trader said South China has geographical benefit for Middle Eastern cargoes, saving on freight compared with the U.S. Diverse supply origin is also good for Chinese importers, he said, adding that Middle East LPG provides Chinese buyers with stable supply, while a term deal could help minimize the risk of paying higher premiums of spot cargoes from the Middle East, or swapping U.S. parcels. He said the main destinations for U.S. cargoes, at least over the next year, would be Japan, South Korea, Taiwan or Indonesia, which may view U.S. supply as more secure, while buyers could hedge their positions via the swap markets. Other Chinese importers such as Wanhua are also expected to increase term volumes with Saudi Aramco next year, a source said, underpinning its focus on raising imports from the Middle East. For 2018 supplies, Wanhua kept total term volumes from Saudi Aramco, KPC, QP and Abu Dhabi steady from 2017 at around 2.3 million. Sinopec Fuel Oil Sales Co. Limited, a wholly owned unit of state-owned Sinopec, also has a one-year contract with Saudi Aramco to buy an unspecified volume of LPG for 2018 deliveries, a source close to the matter had said. And China Gas Holdings, which aims to import around 10 million MT per year of LPG over 5 years, from the current 2.8 million MT per year, plans to sign FOB term deals with producers such as Qatar and Kuwait, as the Hong Kong-listed gas operator and service provider seeks to grow into the petrochemical sector, industry sources had said. Ramthan Hussain, mo.ramthan.hussain at spglobal.com, Cindy Liang at newsdesk at spglobal.com, edited by Jonathan Fox, jonathan.fox at spglobal.com.